All right, good evening. This is Group 4, Jeff Cloud, Khai, Nguyen, Pasha, Sadeghian, Roger Weber, and Andre Testman, and we'll be looking at Ted Baker. All right, so the luxury good industry is a fairly large industry. We're looking at a value of about $324 billion by 2020. More importantly, and what will inform our analysis, is the fact that we project a CAGR of 4% going forward to 2020. This is impressive given the fact that the industry as a whole has recently been challenged most explicitly by global terrorism, particularly attacks in Europe, and then also due to recent changes in U.S. policy that have produced overall reduced travel to the U.S. But most importantly, and what informs our projections going forward for this company, we see a continued rise of the middle class in the developing world. We also forecast Chinese consumer spending to increase, which has had the most significant impact historically on luxury item spending. And we see millennials continuing in their preference for high quality brands, but also more importantly, remaining loyal to those high quality brands. Even better for the long-term trend is the fact that the generation immediately behind millennials, Generation Z, prefers in-store retail, which directly plays into Ted Baker's strength given their current configuration. In terms of our Porter analysis, we've ultimately found the threats to be either low or moderate in the case of bargaining power of suppliers. This is informed from our analysis that the brand ultimately provides quirky yet relevant and ultimately high-end goods that make substitution hard. Additionally, the ability of the consumer to actually bargain for lower prices, one, is not sought by the consumer that frequents this brand, and two, is not really possible anyway, given the high quality nature of the products. And finally, we don't see a very high threat of new entrants, given the fact that an integral part of being a leading member of this segment essentially requires you to be well established. So in this case, the company was founded in 1988. Its closest competitors were similarly founded in the early to mid-70s. At this time, I'll turn it over to Roger for a discussion on value drivers.
A preliminary financial analysis confirmed a number of findings about Ted Baker within the retail and luxury goods landscape that Andre just discussed. Among the findings, profit margins consistent with the high-end retail industry that were actually slightly higher than supergroups. Expansion into new markets has left the company to develop new stores and infrastructure with the goal of aggressively growing brand awareness, which has resulted in investments in property, plant, and equipment, significant inventory turnover, and some increasing debt. Rapid growth in their e-commerce activities, which grew substantially this past year, along with the growth in licensing, have accompanied slower but steady growth in traditional retail and wholesale shipments. As the company moves forward, its strengths are clear. Ted Baker is a quality brand name with a strong reputation. Despite a relatively small number of stores, Ted Baker is growing internationally, and its diverse range of business lines have allowed it to offset some of its weaknesses, perhaps most notably the fact that per square foot sales are declining in its traditional retail business. Ted Baker's profit ratios confirm it's a relatively niche margin brand with a potentially niche clientele. While the wholesale business has been strong, their profits run the risk of being cannibalized by lower margins. While there are many threats, including some competition within the industry, the risk of becoming uncool if they go through a season where their products are deemed unfashionable, potential changes to tax and labor laws, even Brexit, supply chain disruptions. Ultimately, I think we were more intrigued by the opportunities portion of the SWOT analysis, most notably the scalability of their business as a lifestyle brand and the potential to grow licensing and e-commerce as a means of increasing profit margins, ROA, and ROE. The resulting value drivers are reflective of this. Obviously, Ted Baker has the potential to grow beyond clothing. Its licensing business, for example, includes everything from lingerie to sleepwear, footwear to fragrances. Clearly, there's potential for Ted Baker to grow within its home market. performance of retail as a whole. The accompanying potential to maintain high growth in licensing and e-commerce as avenues for this will be essential determinants of the firm's future performance. Finally, we're really interested in the global potential of Ted Baker amid a surging population of young people in places like China and Asia, where they'd like to grow next. The growing presence of a brand-conscious middle class with increasing disposable income in these places offers the potential to grow sales tremendously if adequate investments to grow brand awareness can be achieved. Now, Jeff's going to talk about what these value drivers might mean in terms of scenarios for the firm.
Thanks, Roger. Let's play out a bullish scenario. What they really need is a spokesperson. This may be somewhat improbable, but definitely possible. Let's say that Ronaldo, the Portuguese soccer sensation, is a big fan of Ted Baker shirts. Paparazzi captures him enthusiastically raving to a friend about the quality of Ted Baker shirts, that it's the only brand dress shirt that he'll wear. And it's captured and it goes viral on social media. And Ted Baker is able to retain Ronaldo as a spokesperson, and they launch a very successful advertising campaign. This results in an impressive growth of 30% per year for the next 3 years, as compared to the prior 18% per year before. Somewhat improved pricing power in that they don't have to price down their inventory to get it sold, and a lower cost of goods sold due to economy of scale. These new sales are in large part due to new penetration into the highly brand-conscious Asian market and into a younger consumer demographic. Sales, of course, increase, as does cost of goods sold, but because of pricing, the cost of goods sold, as well as the economy of scale, goes slightly down as a percentage of sales. SG&A and advertising goes up, as does net income. Inventory, receivables, and payables all increase, but are flat as a percentage. This initial increase in working capital somewhat blunts the immediacy of cash inflow, but cash increases strongly. Now, they could decide to pay off some debt with cash, but either way, the increase in overall assets would decrease leverage. Gross profit margins are somewhat improved because of lower cost of goods sold and improved pricing. Asset turnover, as measured by how much they're selling and with their existing assets, are increased. And despite the slight downtick in leverage, the overall effect is an increase in return on equity. Here's to Pasha.
Thank you, Jeff. Based on our assumptions, using the residual income model, we calculated the intrinsic value of the company to be around 1.5 billion pounds or 32.9 pounds per share. You can see a breakdown of the valuation of the company on the screen. Looking at historic prices from 2011 to today, and the current stock price of 29.8 pounds per share, for this bull case scenario, we expect a 10.5% upside. That said, an analyst would have to look at the base case and bear case scenarios in order to make a better stock purchase recommendation. Thank you for your attention.